Hi guys, this is Mutual Funds: An Easy Way to Diversify for Finance 412.
Hi, I'm Lu Yao Zhang, a senior majoring in finance.
I'm Clay Pine, also a senior majoring in finance.
I'm Harrison Mizrahi, majoring in finance as well.
And I'm Jack Tortora, a senior majoring in finance.
So to start, to give you guys the learning objectives, we're gonna, number one, weigh the advantages and disadvantages of investing in mutual funds. Two, differentiate between types of mutual funds, ETFs, and investment trusts, and tell you guys what mutual funds are, give you a nice idea. Number three, calculate mutual fund returns. Number four, classify mutual funds according to objectives. And number five, the culmination of all of it is selecting a mutual fund that's right for you, and we'll explain how to do that. So to start, what is a mutual fund? Essentially, a mutual fund pools together money from investors with similar financial goals. So investments involved could be stocks, bonds, and other things such as REITs, etc. And you're really investing in a diversified portfolio that's professionally managed. So it's a cheaper alternative to giving your money to a money manager and paying 1%. And the investment objectives are clearly stated. So when you invest in a mutual fund, you know exactly what you're getting into and you know what you're investing in with who. So advantages of a mutual fund investing. Diversification and safety. So according to the mutual fund that you invest in, you invest based on risk aversion. Next, there's also professional management. So it's not just a random person investing in a Robinhood account, it's a professional controlling what the fund invests in. And it's also a cheaper option versus using an investment manager. You don't have to give a minimum investment of $1 million. There's funds that can range anywhere from $100 to $2,500 minimum investment. So you can kind of be a normal investor, not an ultra high net worth investor, and still take advantage of mutual funds. There's also easy liquidity, flexibility, and like I said earlier, the objectives are clear in the prospectus. So you know exactly what you're investing in and the goals of the people that you're investing with in the fund. Some disadvantages are that very often they underperform compared to the market. So the S&P 500 index can beat it, and we'll show you a graph in a couple slides that displays that over the last year. Fees can be higher compared to index funds, a lot higher, but that's what you're paying for the active management for. Index funds are just another example of something else, another strategy, and they're passive. And then capital gains payouts. Investors don't have control when you get capital gains payouts. So that's based on the investment managers. And that can kind of make the tax strategy bad. If you wanted to reinvest your earnings, you're not able to do that. You have to pay taxes on what you have to pay out, and the distribution, again, isn't based on what you want. It's based on what the pool wants. So this is a graph that shows the average mutual fund performance versus the S&P 500, which is a good market tracker during the COVID-19 crisis. And the S&P was slightly above the average mutual fund performance from the beginning of the COVID crisis to now.
And I will talk more about mutual fund fundamentals. There are proportions of the ownership of the mutual bonds portfolio. Investors invest money to buy the bonds, and the mutual fund manager take the money to buy the securities. And then the shareholders have the proportion of the ownership of the bond. And here is a special note. The mutual fund shareholders don't directly own the fund security. They own the proportion of the overall value of the fund itself. And please go to the next slide. And when you own shares in the mutual fund, you make money in three ways. First, as the value of the security held by the as the value of all securities held by the mutual fund increase, the value of each mutual fund shares goes up. And the second way is shareholders get the interest or the dividends from the fund's holding in the form of dividends. And lastly, if the fund sells a security for more than it's originally paid for it, the shareholders receive these gains in form of capital gains distribution, generally paid annually. And please go to the next slide. And then let's look at how the mutual fund is organized. The fund itself is generally set up as a corporation or trust, and it's owned by the fund shareholders who select a board of directors. The fund is then run by the management company, generally the group that initially organized the fund. Often a management company will run many different mutual funds. Each individual fund then hires an individual investment advisor, generally from the management company, to oversee the particular fund. The advisor supervised the buying and the selling of the securities, and the advisor is generally paid a percentage of the total value of the fund on the annual basis. The management fee usually runs about 1/2 of 1%. And go to the next slide, please. A mutual fund is a special type of the investment company. The investment company is the firm that invests the pool of money of a member of investors in return for a fee. And there are 4 types of investment company: open-end investment company, closed-end investment company, unit investment trust, and the real estate investment trust. And please go to the next slide. The open-end investment company is a mutual fund that can issue new shares. The value of all the investment that the fund holds determines how much each share in the mutual fund is worth. The price that you pay when you buy your ownership shares and the price you receive when you sell your shares are based on the net asset value, which is the dollar value of the shares in the mutual fund. The formula equals to the total market value of all securities minus the liabilities divided by the total shares outstandings. And here is one example. If the value of the fund's holding is determined to be $850 million and the liability are $50 million, and there are 40 million shares outstanding, the net asset value would be equals to $20 per share. And the closed-end investment company is a mutual fund that can't issue new shares, and it is a fixed number of shares. The value of each share is determined both by the value of the investment the fund holds and the investor demands of the shares in the funds. Because the price of the ownership shares in the closed-end fund is determined by the supply and demands for those shares, not by their net asset value. Shares in some closed-end funds actually sell above the net asset value, while others sell below it. And please go to next slide. The unit investment trust is a fixed pool of securities in which each shares represent a proportionate ownership interest in the pool. The bonds are purchased and then held until maturity, at which time the trust is dissolved. It works as an investment company announced the information of the trust and then advertise and sells the ownership shares through brokers. The investment company's role is to collect and pass the interest and principal payment accruing from the bond portfolio to the investors. And the advantage of unit investment trust comes from the diversification that they offer. Many municipal bonds are relatively risky, and as a result, diversification holds the real value, and there are the minimum requirements, which is $1,000 subtract the sales commissions of 3.5 to 4.9%. And please go to the next slide. And there are real estate investment trust, which is specialized in the real estate, and most rights have no predetermined lifespan. It must collect at least 75% of its income from the real estate and must distribute at least 95% of the income in form of dividends. And there are three types of rights, which is equity, mortgage, and a hybrid of the two. The equity is buying properties and manage it. With the mortgage, investor receive interest payments only. A hybrid invest in both property and mortgages, resulting in some interest and capital appreciation. And please go to the next slide. And here is the fund that you should be careful with, which is called hedge funds. It is the investment pool with very few controls. It's very risky and which has a very high fee with the poor performance, and it only allows wealthy investors to invest. And please go to the next slide.
So when picking which type of investment vehicle is best suited for you, it's important to understand what the costs of the investment are and how to calculate the return after all these expenses are taken into account. Mutual fund returns can come in the forms of dividends, capital gains, and the change in net asset values. Dividends and capital gains are more straightforward, and the formula for net asset value is as follows. It's the total market value of all securities minus liabilities divided by total shares outstanding. It's important to keep note of because, as seen at the bottom of the slide, the formula of the total return of a mutual fund is dividends distributed plus capital gains distributed plus ending net asset value minus beginning net asset value divided by beginning net asset value. Different funds like ETFs and index funds and mutual funds all have different fees. The types of fees often seen in mutual funds are the annual management fees, commission fees, and marketing expenses. All these combine to make the expense ratio, which are the expenses divided by total assets. This is the most looked at ratio in the world of mutual funds, and generally the lower the ratio, the better. Sometimes there are also financial advice and planning fees, which are sometimes included in the expense ratio. And these occur when the mutual fund hires outside advisors to manage funds. Additionally, turnover rates show how frequently funds make transactions, which means more expenses. What's interesting is that most actively traded mutual funds do not outperform the S&P 500, which is mostly because of the number of fees that are associated with these actively traded managed mutual funds, which is why experts often say to leave your money in good long-term assets and tuck it away and not try to beat the market because more transactions calls for more expenses. Now I'm going to elaborate a little bit more on what Liao said in our previous slides on understanding the different types of mutual funds. Mutual funds come in all types of shapes and sizes, so it's important to understand these different types and how their fee structures affect total returns. When it comes to loaded and non-loaded funds, load is a commission upon the buying and the selling of a mutual fund share. These loaded funds are broken into different share classes. Class A shares pay when bought, Class B when sold, and Class C pay as you go. And obviously no load funds have no commissions. Open-end funds have to do with the number of shares issued in the mutual fund. This comes into play when calculating the net asset value because outstanding shares are in the equation. An open-ended fund means that the financial advisor can add unlimited shares, while closed-end funds have a specific number of shares that cannot be altered. Okay, now I'm going to walk through some tables from the SEC government website's report on mutual fund fees and expenses. Also, take note that these studies are older. Numbers have changed, but I'll explain how they've changed as I go. Table 7 on the left highlights the rising popularity of interest rates or of mutual funds from the 70s to the 90s, while Table 9 shows how expense ratios have differ between different investments and how these rates have increased over time as investors realize that their savings were better off managed by professionals in a fund or mutual funds rather than with individually picked stocks that they do themselves. These expense ratios are from older studies, and they've actually decreased over time as competition's increased and had technological enhancements in the financial industry makes it cheaper in terms of costs, and are normally around or below 1%. These next two tables break down the expense ratios based off of the ages and the sizes of mutual funds. Once again, it's important to understand the differences in expenses of different funds when trying to pick the best investment vehicle for yourself, depending on your time horizon and your risk appetite. Generally, older and larger funds have lower expense ratios and generally offer less risk with the lower reward ceiling. Okay, so here are the key takeaways when understanding mutual fund fees and structures and how they come into play when calculating mutual fund returns. Lower expenses can translate to higher long-term returns compared to similar funds with higher expenses. Index funds and ETFs generally have lower expenses compared to actively managed funds, and they can have expense ratios lower than 0.1%, whereas average expenses of mutual funds can be 10 times higher due to the higher trading fees. Then again, many people prefer actively traded funds because the financial advisors often can time markets and do better when they're not trading at all. But with all that said, the funds with the lowest expense ratios are not always the best. Therefore, when analyzing a mutual fund, the expense ratio is just one of the several things to consider before you buy the fund. So try to find a mutual fund with a long track record of returns that are higher than the S&P 500. These are rare. It's only about 20% of them, but they're certainly out there. You put in the time to find them.
All right, I'm going to talk about the different types of mutual funds and their classifications. First, we have money market mutual funds, which invest solely in cash and cash equivalents, which are also called money market instruments. These can be certificate deposits, treasury bills, and other short-term investments that are less than 30 days, which makes them safer while buying securities from large corporations and the government with a low default risk. So those type of investments are taxable, but there's also tax-exempt money market funds. And these funds invest exclusively in securities issued by the state and local governments, and therefore are tax exempt from federal taxation. These tax exempt funds appeal to investors in a higher federal tax bracket who seek tax savings on interest income generated by the portfolio, although they do provide a lower yield. And so these money market mutual funds carry no loads, as Jack explained before. So there's no commission, which were front-end loads, back-end loads, or pay-as-you-go. And they have a minimal expense ratio, which you can see on the right, which Jack also said before, which was the total fund cost over the total fund of assets. Next, we're going to talk about stock mutual funds and the different types of stock mutual funds. The first one, we have growth funds, which his main goal is to provide capital growth. So in exchange for more growth, you're likely to experience more ups and downs in the value of your investment due to the fact that it's a more aggressive style, unlike bonds, which is a safer side. Investments held in these funds are companies that demonstrate high growth potential, but also carry greater risk, making them have more volatility. Next, we have value funds, and they follow a value investing strategy and look for stocks that are undervalued in their price. They're also compared to growth funds in the sense that they're looking for emerging companies with high growth potential also, which is pretty much the same and making them risky also. And the premise behind the value investing strategy is that once the market realizes the true value of these stocks, the share price will increase and the investors will gain revenue. Next, we have the sector funds, and these funds make investments in well-defined market sectors such as infrastructure, real estate, or technology. And investing in sector funds gives the investor an opportunity to profit from the trends in these certain sectors. So for example, by choosing a technology sector fund over an individual technology stock, you're protected from firm-specific risk because you're dealing with the entire sector. These funds only focus on one area of the economy, which makes them more volatile because they're not very diversified, because usually the trends go in one direction with each other. Next slide. We're going to talk about a few more stock mutual funds. Next, we have index funds, which are designed to mimic the composition and performance of a financial market index. An example of this would be like the S&P 500. With this fund, it gives the investor a broader market exposure, and they have lower expenses and fees than actively managed funds. Index funds seek to match the risk and return of the market. So on theory that in the long term, the market will outperform any single individual investment. And last of the stock mutual funds, we have the international fund, also known as foreign funds. Investors can invest in any country of their choice located outside the investor's country of residence. And they can include developed, emerging, or frontier market investments in a range of asset classes. And these funds can offer varying levels of risk and return. So next we're going to talk about a balanced mutual fund, which is a combination of stock, bond, and money market components all into one single portfolio. The fund's objective is somewhere in between growth and income, so they're not too aggressive or too passive in their investing, and is usually geared towards investors looking for a mixture of safety, income, and moderate capital appreciation. These funds are less volatile than stock mutual funds due to the fact that there's a mixture of different components and not based on an aggressive investment style only. And as you can see in the bottom right picture, some balanced funds are either equity oriented or debt oriented. So in this picture, it shows an equity oriented with a more emphasis on growth and capital appreciation, while still having the stability come from a little bit less of a percentage from the debt. So lastly, we have bond funds, and these funds primarily invest in bonds which can be government, corporate, municipal, or convertible. And these funds provide instant diversification for investors for a low required minimum investment. And due to the inverse relationship between interest rates and bond prices, a long-term bond has a greater interest rate risk and a short-term bond. And since the interest payments are made monthly and reflect the mix of all the different bonds in the one fund, the interest income distribution will vary monthly depending on the value of the fund. And then lastly, investors use small amounts of money in these specific funds, so they're able to keep their investments liquid.
Okay, so knowing all that we know about mutual funds now, although we've learned throughout this presentation, the most important thing is how do we put that all together and choose the mutual fund that's right for us? So the first step is to determine your goals. So investment goals are what you need. Are we doing this for college fund for our kids or for our retirement? Do we want income now or do we want to have more income later? What's our risk level? Are we younger on our age and should we be a little bit more aggressive, or are we older and should we keep the money that we've made and kind of grow it slowly without losing it? And what's our time horizon? So all of this really factors into which mutual fund you'll go with. Step 2 is meeting objectives. So like I said, do we want to be aggressive or more on the safe side? What am I investing for and in which sector? Do I want to go emerging? Do I want to go growth? Do I want to go large cap, low cap, whatever it is? So it's very important to know exactly what you're investing in and why. And there's a lot of ways to find out what you're investing in and why, because it's all public information. So when you're selecting the fund, which is our final step, you can consider past performance. So it's not always a way that tells you what the future performance is going to be, but it's a pretty good indicator. The fees and costs. Does it make more sense to invest in this mutual fund compared to another? Or are we losing money on the fees and costs and should we just choose another route? And then the fund's prospectus. A lot of times the fund's prospectus is either online or you can call the mutual fund and they'll send you over a PDF of it. It talks about the goals, the manager's experience, the tax considerations, the fees, and it pretty much gives you all the information about what you're investing in. So more than anything, it's very important to know what you want to invest in, why you're investing, and also who you're investing with. Where's the money going to go? How is it going to be put to use for you? And is it the right move for you at this time? So that's our presentation on mutual funds, and we welcome your questions. Thank you.